and welcome to another installment of Liberty Nation Swamponomics videocast. I'm Andrew Moran, Allen's economics correspondent. Each week, I dive into the morass of top economic news stories and fish out compelling narratives, or I retrieve fallacies that have been accepted as conventional wisdom by the swamp creatures for years. This week, the global bond market crash you didn't hear about. The tech-heavy Nasdaq has slumped 20% year-to-date, officially entering a bear market. Crude oil prices are above $100 a barrel. The US dollar index, a gouge of the greenback against a basket of currencies, is at its best level in 5 years. Inflation is at a 40-year high, gasoline prices are north of $4, and the coffee market is in disarray. But if you read a business headline or watched any of the major business news networks, you're probably aware of these developments ongoing. But here is something you might have missed on the evening news: the bond market crash. The Bloomberg Global Aggregate Index, a benchmark for global and corporate debt, has slumped 11% since hitting a peak in 2021. In other words, the global bond market lost $2.6 trillion after touching a record last year. This is the largest loss in bond market history. For decades, the conventional wisdom offered by financial experts is that bonds provide investors with a regular and safe income while also functioning as a hedge against chaos in the broader financial markets. So, what is going on exactly with this bond crash? Well, with the central banks, including the Federal Reserve, on a fierce campaign to tighten monetary policy in a bid to curb inflation, losses in global bond markets have been remarkable to watch unfold. As more institutions raise interest rates, some more aggressive than others of course, those who get in the bond market now will certainly receive a better return on their investment than if traders bought a couple of years ago. For example, the benchmark 10-year treasury yield is close to 3%, but if investors bought that same debt instrument at the start of the pandemic, you would receive a paltry yield of about 0.5%. And this is why market analysts believe there is more room for a bond market rout, because central banks are putting the pedal to the metal on quantitative tightening, or QT. The Fed plans to be more aggressive. The Bank of Canada is leading the pack on rate hikes. The Bank of England started the rate hike before everybody else, and the European Central Bank is getting in on the action, albeit at a slower pace. Remember, the real yield on bonds, which factors inflation, is still putrid. Another factor that only a few market experts are talking about is higher borrowing costs. With rates trying to return to a neutral level, higher borrowing costs could diminish the return on debt, buoyed by skyrocketing inflation. That said, this is really throwing a wrench into the 60-40 investment portfolio, one that comprises of 60% stocks and 40% bonds. Stocks, which would typically be attractive when bond prices or yields are low, are in a correction or even bear market. The bond segment is crashing, while inflation could be spiraling out of control. There is nowhere to hide right now, unless you bought at the very bottom of the COVID-induced market crash on March 23, 2020, and choosing to withstand the turbulence after all this time. As this program recently stated, this is not a normal economy. With a strange type of recession on the horizon, we might need to enroll in Bellevue soon. That's it for me this week. Please read my full Swamponomics column, where I discuss Chinese stocks, the IMF's "oops, I did it again" moment, and global gold demand. Thank you.
We're doing it for real, really real. Liberty Nation.
And Jeff Charles, contributor for LibertyNation.com.
I think we're starting to make an impact. Liberty style, fight for freedom.
The tracking poll sponsored by Liberty Nation for Thursday.
Mentioned by Dan Bongino, Rasmussen, Jordan Peterson, and
I
others.
can do it again if you want me to.
Cited in Mark Levin's American Marxism.
I think we're starting to make a really big impact. Get noticed. We're doing it. Rock on. I'm gone.